So, the global financial system is under stress right now. You dig? Not could be stress, not analysts are worried stress, right now stress. And the scary part, most people don't even know what they're looking at. Let's start with, well, the Japanese yen, right? The USD JPY. I know a lot of you guys have heard me talk about this one, but anyone who's new here or whatever, I just want to just touch on it a little bit, right? So the USD JPY is the currency exchange for the US dollar to the Japanese yen. It is sitting right around that 159 level. Now, the 160 level is very important, and I will show you why. But the new Fed chair just got sworn in by the same president who hand-picked him. Private credit, a $1.8 trillion shadow market. It's quietly cracking. Maybe not so much quietly anymore, but it's cracking. Bond markets around the world are in full fucking revolt. And, well, inflation back above 3.8%. That's a 3-year high. Meanwhile, the stock market just keeps going up. And retail traders, well, they're pouring money in like it's 2021 all over again. You dig? So connect the dots. And then the picture becomes wild. So let's connect them. You dig? So I know I've broken down the yen carry trade before on this channel, actually many times. But let's do a quick refresher. If you're new here, welcome to the Bag Brigade. It's your boy Chuck Boomberg. So, for decades, right? Japan kept its interest rates at basically zero. So, global funds, private equity, institutions, hedge funds, you name it, right? They borrowed in yen because it was cheap, basically zero. And then they converted it into the United States dollar or any other currency that had higher interest rate. And then they pocketed that difference, the spread, right? Then they parked that in money, they invested it across the board, right? US treasuries, bonds, stocks, emerging markets, commercial real estate, residential real estate, crypto, you name it, it's there. And it's about an estimated 300 to 500 billion dollars still in outstanding positions. So what's new? Well, the Bank of Japan is now at 0.75%. Okay. That's 50 basis points or 0.5% higher than it was when they hiked in August of 2024. At their last meeting, April 28th of this year, they decided to hold, but the vote was 6-3. 3 board members wanted to hike. That's the most divided the Bank of Japan vote has been in years, if not decades. One member publicly stated, and I fucking quote, "It is quite possible that the bank will raise the policy interest rate from the next meeting onward." So traders or investors, they're pricing in a 77% chance of a hike at the June 16th meeting. Shocker, right? Well, here's the fucking wild part. That same day, that's Kevin Warsh, the new Federal Reserve Chairman of the United States. That's the first FOMC meeting for him. What a coincidence. Think about that for a second, okay? The Bank of Japan and the Fed. both meeting on the same day, both with major decisions to make. If those two moves collide in the wrong way, you better buckle the fuck up, okay? It ain't gonna be pretty. Now, here's something that should be front page news, but isn't getting enough attention. The global bond market is in a full blown sell off. No joke. Okay. And I've been talking about the bond market for years now. The US 30-year Treasury yield just hit 5.2%. That's the highest it's been since fucking 2007. The 10-year yield, it's at 4.6%. Biggest weekly jump since the tariff shock of last April or April of 2025 during Trump's fucking Liberation Day debacle, right? But it's not just the US. See, Japan's 30-year bond yield hit an all-time record. Okay. Germany's 10-year bond, highest since 2011. The UK guild yield, highest since '08. Rinse and repeat, people. This is a synchronized global bond sell-off that doesn't happen often. And when it does, it means something. See, bonds are like snitches. They kind of give you a little idea of what's coming. Or at least that's what I say. They're like snitches because they are. What it means, like, what does all this mean though? See, bond investors, the so called fucking smart money, they're losing faith that governments cannot manage their fucking debt loads. The US alone is sitting on nearly $39 trillion with a T in national debt, growing at $7.4 billion every single day. And every time yields rise, the interest payments, well, they get worse. It's like a doom loop, you dig? Higher yields mean more expensive mortgages, more expensive business loans, more pressure on everything from housing to corporate earnings. Foods prices go up, gas, everything, you name it, right? Here's the kicker: the bond market is supposed to be the boring one, right? When bonds are making headlines, you better pay fucking attention. You dig? Let's talk about the new sheriff in town, Kevin Warsh. Just replaced your own pal. It's the chairman of the board for the Federal Reserve, United States. See, Kevin Warsh was just sworn in as the 17th Federal Reserve chair, confirmed 54-45. Most divisive Fed vote in modern history. One Democrat crossed over, John Fetterman. That's it. Like, old Trumpy Dumpy personally swore him in. He did that with Powell too in 2017, by the way, at the White House in the East Room. Then looked into the camera and said, and I quote, "I want Kevin to be totally independent. Don't look at me." Trump said that. Go look it up. The man he handpicked after months of publicly demanding rate cuts. Sure, totally independent. You do? Like, it's fucking crazy. It's just everybody just watching this shit happen. See, here's the problem that Warsh inherits. Trump wants rate cuts. Warsh is staring at 3.8% inflation. That's a 3-year high. Energy prices up 18% basically year over year, thanks to the Iran conflict. And bond yields are screaming higher. Markets are pricing no cuts for the rest of 2026. Some analysts are betting on rate hikes in early 2027 or before, depending on how things shake out. You dig? See, and Warsh, well, his stated philosophy, I guess, shrink the Fed's balance sheet. Less QE, quantitative easing, less intervention. Let markets find their own price. Right? Wild. That sounds fine in like a textbook or some shit, but we've got nearly $39 trillion in debt, rising yields, a private credit market that is cracking, and a geopolitical war spiking inflation from the outside. His first policy meeting, June 16th, June 17th, not that far away. Same day as the Bank in Japan, too, remember. The whole world is going to be fucking watching. So you better be too. Like, here's a question I keep getting. And I used to be guilty of this too. Shout out to my homie Twix. We were having a little conversation earlier about this exactly. But basically, the question I keep getting, hey, Chuck, if everything's so fucked up or messed up, why is the stock market going up? Well, the S&P 500 is near all-time highs. Actually, I think it's at all-time highs right now. Corporate earnings are beating their expectations. 84% of the S&P 500 companies beat profit estimates in Q1 this year. Goldman Sachs is projecting another 12% total return this year. But look fucking underneath. Consumer purchasing power down, especially when you adjust it for inflation. And that's also, let me bring up a fun little fact here. Just since the start of COVID, 6 years ago or so, the United States dollar's purchasing power has lost nearly 25% in a 6 year period. Think about that for a second. 25%, meaning 6 years ago, your money could have bought you 25% more. We hadn't seen anything like that in a dollar, purchasing power move, especially to the downside like that, since the 1970s, okay? During the oil embargo and crazy, outrageous inflation, the Volcker days, right? But, anyways, just wanted to get that out there. But you also have credit card delinquencies on the rise, like we haven't seen in a long time, if ever. Personal bankruptcies rising. Real wages, they're fucking lagging. So, what's propping up the market? Tell me. I don't know, right? No, I mean, I don't know. Two things, in my opinion, right? Number one, AI spending. There's a massive infrastructure build out happening in semiconductors and data centers. That spending is real. It's enormous, huge. China. And it's concentrating gains in a handful of mega cap tech stocks. The Mag 7s, your Teslas, NVIDIAs, your Microsofts, your Googles, your Apples, your Broadcoms, NVIDIAs. I mean, I could go on and on and on, right? But that's what's happening. Number two, and this is the one that should make you a little fucking nervous, retail traders. Yep, that's right. Retail traders. So let's talk about this retail flood here we got, right? So retail investors poured a record $308 billion into US stocks in 2025 alone. That beat the 2021 meme stock peak by 14%. And in January of this year, 2026, they broke that record again. $350 million in net stock inflows in a single month, with option inflows hitting an all-time high above 300 million. Then the tariff scare hit, back in April 2025. Institutions fucking panicked. 74 billion flowed out of equity funds, right? Now, what did retail do? They bought the fucking dip, which was actually pretty smart, even though questionable. Over $50 billion, okay, in retail investments in just alone this year since April 8th. 50 billion. The people who bought between April 3rd and May 9th, well, they got to be up nearly about, I don't know, 12%. So retail is being rewarded again for buying every dip, which means they're going to keep fucking doing it until the one time it doesn't bounce back. And now retail money is concentrating into mega cap tech and semiconductors, right? The exact same names driving the AI rally. It's a feedback loop. Prices go up, retail piles in, prices go up more. But see, here's where things get really fucking interesting. The rules are changing. They are. On June 4th, less than a week from now, the PDT, the pattern day trading rule, is officially dead. For 25 years, if you wanted to day trade on margin, you needed at least $25,000 in your brokerage account. That was the floor. Okay. Below that, you were limited to 3 day trades per rolling 5-day period. So 3 day trades in 5 market days. You know what that means, right? Cool. The rule locked out millions of retail traders. I mean, I guess you could have been on a cash account. The difference between cash account and being margin is like, when you get on Robinhood or whatever, and you deposit $1,000, right? Typically, a bank, the transfer between the bank and the brokerage, it takes a few days. But when you get that instant deposit, that's also another form of margin. They are loaning you that money immediately. It's not the same kind of margin like for futures trading and all that, but it's still margin. Okay. So a cash account is basically where you you put $1,000 in your brokerage. You have to wait the 3 days or however long it takes, and then you can day trade as much as you want. The only problem with it is, and it's not really a problem, it's just more of a patience issue, or I guess a liquidity issue for retail traders, is that if you say you bought an option for $400 or $200 or whatever, multiple of them, and yeah, you made gains on them and you cashed out of it. But here's the deal: you had to wait, right, for that to settle. It usually takes a day, maybe two. Had to go through the clearinghouse for you to be able to get that capital back and trade with it again. So if you weren't trading with, a decent amount of money, you could get locked out because you just didn't have the liquidity in the first place to make another trade that day. So if you were on the margin situation, you could do that and get your profits right back. But again, you were limited to 3 out of 5, trading days. Make sense? Okay. Well, they're just now changing that. Basically, on June 4th, it's gone. Okay. Any margin account over $2,000 gets intraday buying power. No more day trade counters and no more PDT flagging, pattern day trading flag. Been there, done that. So now brokerages have up to 18 months to fully implement it. So not every platform will flip the switch on day one. Okay, get that straight. But I guarantee you fucking Robinhood and a lot of those will. but the regulatory barrier here, it's been eliminated. Think about what that means combined with the retail flood we just talked about. You're removing the guardrails at the exact moment that record amounts of retail money are pouring the fuck in. But wait, no, there's more. Okay. The CBOE now offers nearly 24-hour trading on S&P 500 options, VIX options, and the Russell 2000 options. 5 days a week. Not SPY. Okay, don't get that wrong. I'm talking SPX, VIX, VIX, and RUT, the Russell, like the actual indices, not the cash ETFs. 5 days a week, extended hours for individual stocks or stock options, whatever, start July 13th. Global trading hour volumes were up 27% in 2025 alone. This is not a niche product. This is becoming the new normal. So let me paint the picture. Record retail inflows, day trading restrictions removed, option markets open nearly around the clock on certain things, all while inflation is running hot, bonds are selling off, and geopolitical risk is fucking elevated. That is either the greatest opportunity in a generation or the setup for one of the most spectacular retail wipeouts we've ever fucking seen. Or maybe both. We're going to find out. That's for fucking sure. You dig? I know I've talked about this as well in previous videos. Private credit, right? I've talked about private credit on this channel. I get that. So I'll keep this tight, but this is for the new ones, the new people. But the situation has gotten worse. Just some quick numbers, okay? $1.8 trillion market built after 2008 when banks stopped lending to mid-sized companies. No public reporting, no fucking transparency, okay? You dig? That's why it's called private credit. Default rate 5.8% and climbing. Morgan Stanley's worst case says 8%, while UBS worst case says 15%. 162 billion maturity wall hitting this year alone. Debt that needs to be refinanced at quadruple the original interest rate. Just think about that, right? And here's the number that should really fucking scare you. 94% of all private credit downgrades in the past year were distressed exchanges. Quiet renegotiations designed to avoid formal bankruptcy. Translation here, okay? They're hiding the fucking bodies. And major funds are already getting redemptions, telling investors, hey, you can't pull your money out right now or anymore. Is it 2008 again? Probably not. But the pattern, rapid expansion, capacity, rate shock, silent defaults, it's identical every single fucking time. So let's zoom out a little bit here then, huh? These are not separate fucking stories. No. They're interlocking gears on the same machine. The yen carry trade is a $300 to $500 billion bet that global rates stay stable. If the Bank of Japan hikes on June 16th and the market says 77% chance, well, those positions begin to unwind. The new Fed chair is politically compromised from day one, inheriting stagflation dynamics he can't cut his way out of. That's for sure. The bond market is in a global revolt right now. Yields at multi-decade highs from Tokyo to London to fucking Washington, okay? Private credit is running shadow defaults on companies that are already technically fucking insolvent. And on top of all of that, the stock market is near or at all-time highs, powered by an AI spending boom and a flood of retail money from traders who just got their guardrails fucking removed, okay? What this means for regular old folks like us, right? Or you, whatever. What is regular anyway? Your mortgage rate stays higher for longer, maybe even goes higher. Your 401k, well, that's exposed to private credit through pension allocation and to concentrated tech risk through index funds. Your grocery bill, still inflating 3.8%, and energy up 17.9, basically 18%. And if you're one of the millions of retail traders who just got the green light to day trade without restrictions, understand what you're walking into. The opportunity is real, but so is the fucking risk. I'm not here to scare you, okay? That's not what I'm doing. See, the people who understood the carry trade in August of 2024, they weren't shocked on August 5th. The people who understood private credit or, you know, the mortgage-backed security crisis and credit default swaps and CDOs, collateralized debt obligations and things like that back in 2006, well, they weren't shocked in 2008. See, knowledge is the edge. Full stop. If you want to go deeper into any of this, right? The macros, the flows, the data behind what I just laid out, well, the Bag Brigade Discord community is a place where we kind of break it down daily. You can go to thebagbrigade.com. There will be a link on the website. There will also be a link in this description of this video, and it's also on the YouTube page and our Twitter page, X, whatever you want to call it. You do have to fill out an application, though. It is a private community. It doesn't cost anything, but it is a private community that you do have to fill out an application. And either myself or one of the mods, they will review the application, potentially interview you, accept the application, and then you're in, or reject it. And that's just the way it is. There is no ways around that. Okay. But don't sleep on it. Okay. Because right now, like I said, it is free. I mean, that could change. I don't see it changing, but I'm just saying, don't sleep on it. Yeah, that's all I got for this one. Hopefully this was helpful. I just wanted to make a quick one real quick, and I'll leave it with what I always leave it with. I don't ask why. Stopped doing that shit a long time ago. I ask, why not? Well, because why not, right? Maybe it's because I made something out of nothing. So thanks for nothing, right? And to all the haters and other YouTube gurus and other people who've said things and whatever you want to say, ooh, right? Or especially the fake Chucks out there on Discord that pretend to be me and all that. Well, there's only one Chuck. Okay, that's me. So be careful, because before they cross me, you're gonna have to nail me to it. And again, I no longer try to, right? I no longer accept the things that I cannot change. I change the things that I no longer am willing to accept. And that's where I am today. You dig? Anyways, it's your boy Boomberg. Stay informed. Stay ahead. Boomberg out.